Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dongjiang Environmental Company Limited annual report. Dongjiang Environmental Company Limited provides a wide range of environmental services in the People's Republic of China. The company operates through 8 distinct segments, each catering to different aspects of environmental management. The Industrial Waste Resource Utilization segment focuses on recycling and utilizing industrial waste, while the Industrial Waste Treatment and Disposal segment handles the treatment and disposal of such waste. In addition, Dongjiang Environmental Company Limited offers municipal solid waste treatment and renewable energy utilization services through its Municipal Waste Treatment and Disposal segment. The company also provides engineering, environmental remediation, and monitoring services to ensure a safe and healthy environment. Furthermore, it manufactures metal salt products, including feed-grade copper sulfate, basic copper chloride, and electroplating-grade copper sulfate. In terms of renewable energy, Dongjiang Environmental Company Limited is involved in its utilization and production. The company also offers waste electrical appliance disassembling and utilization services, as well as environmental protection services to minimize the impact of human activities on the environment. Overall, Dongjiang Environmental Company Limited's diverse range of services and products makes it a comprehensive provider of environmental solutions in China. Dongjiang Environmental Company Limited market capitalization of 4 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that Dongjiang Environmental Company Limited holds a significant advantage in their industry. Dongjiang Environmental Company Limited trades at a higher price-to-book ratio of 0.89 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 63% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a company can be attributed to various factors. On the positive side, revenue growth is primarily driven by waste electrical and appliance treatment and dismantling, renewable energy services, operating revenue from sale of recycled products, other business, industrial waste recycling, and waste electrical appliance dismantling treatment. These segments have shown significant growth rates, ranging from 21.1% to 59.6%. On the other hand, revenue decline is primarily driven by municipal waste appliance, dismantling engineering and services segment, rare and precious metals recycling segment, service income from industrial and municipal waste treatment and disposal, revenue from environmental engineering and services, renewable energy utilization, lease revenue, operating revenue from industrial waste treatment and disposal, and revenue of rare and precious metals recycling business. These segments have shown significant decline rates, ranging from 13.5% to 38.4%. The net income of the company experienced a significant decline between 2024 and 2025. The net income decreased by $456,021,490.52, indicating a substantial drop in profitability. This decline was further emphasized by a year-on-year decrease of RMB 460 million, resulting in a loss of RMB 1,340 million. The profit margins also underwent a significant change during this period. Operating profits and total profits both decreased, with the latter experiencing a more pronounced decline of 460 million, $304,424.83. Furthermore, the profit margins for most segments were negative, indicating that the company was operating at a loss in these areas. The widening of profit margins can be attributed to two main factors: the significant decline in revenue from harmless treatment business and the decrease in collection and transportation prices. These changes had a cumulative effect on the company's profitability, leading to a substantial decline in net income and profit margins. The analysis of the company's financial data reveals a consistent trend of generating positive operating cash flow. This can be seen in multiple pages of the extracted summaries, where net cash flows from operating activities are consistently reported as positive. For instance, on page 9, the net cash flows from operating activities amount to RMB 387 million, 31,238.88 in 2025. Similarly, on page 11, the net increase in cash and cash equivalents is 83,565,662.08, indicating a significant influx of funds into the company's coffers. Furthermore, other relevant data points also suggest that the company has sufficient funds available for operational needs. On page 22, it can be inferred from accounts receivable and other data that the company has a positive operating cash flow. Additionally, on page 30, the operating cash flow is reported as RMB 387 million, which is another indicator of the company's ability to generate positive cash flows. The fact that the unused net proceeds from various projects are being used to replenish general working capital, page 38, also suggests that the company has sufficient funds available for operational needs. Overall, these data points collectively confirm that the company is indeed generating positive operating cash flow. The company's debt level has undergone significant changes over the past year. Total liabilities have increased by a substantial 39%, rising from $7,085,646,097.20 to $9,907,627,901.02. However, this increase is largely due to an increase in short-term borrowings, which rose by $451.7 million, or 38%. On the other hand, long-term borrowings decreased by a significant 43.5%, amounting to $1,2,476,928.28. Despite these changes in debt levels, interest expenses have actually decreased. The company's total interest expenses dropped by $8,153,156.69, representing a 4.1% decrease from the previous year. Furthermore, net interest expenses in the renewable energy sector plummeted by an impressive 92%, decreasing from $265,464,317.02 to $21,317,848.29. Additionally, finance costs decreased by approximately RMB 5 million. Overall, while debt levels have increased, interest expenses have actually declined, indicating a more manageable financial situation for the company. The company's performance in various segments and regions has been mixed, with some areas showing significant improvement while others have declined. In the poor-performing categories, rare and precious metals recycling saw a substantial decrease of 16.3%, amounting to $140.1 million. Service income from industrial waste treatment and disposal also decreased by 21.5%, followed closely by service income from municipal waste treatment and disposal, with a decline of 10.7%. Revenue from environmental engineering and services dropped by 28%, while renewable energy utilization saw a decrease of 37.8%. On the other hand, industrial waste recycling showed impressive growth, increasing by 20.8% to $271.6 million. Waste electrical appliance dismantling treatment also performed well, with an increase of 60.4% to $70.5 million. These positive results suggest that certain areas of the company's operations are thriving despite overall mixed performance. Management is optimistic about the company's outlook, citing its strong financial position and adequate liquidity to support future growth. This confidence is reflected in their approach to managing interest rate risk through the use of floating-rate bank loans. However, they acknowledge a potential vulnerability in not having measures in place to mitigate foreign exchange risks. The company has a history of distributing its profits to shareholders through dividend payments. According to the financial records, in 2024, the company made significant cash payments totaling $191,015,312.90 for the distribution of dividends and profits. Additionally, in 2025, the company's subsidiaries distributed $8,950,000 to minority shareholders as part of their dividend payments. These transactions demonstrate the company's commitment to returning value to its shareholders through regular dividend distributions. That concludes the financial summary for Dongjiang Environmental Company Limited. Feel free to comment below, and I will be happy to answer them when possible.